Well, today there is a global risk-off. The trade uncertainty looms. White House has taken a tough line against China, and all eyes are going to be on the G20 meet and whether we see a US-China, some progress on that. Otherwise, tariffs on $300 billion worth of imports get imposed. How are you feeling about the global markets and all this trade uncertainty?
Yeah, look, I actually think we should treat it as a positive in terms of there is a lot of concern about the trade situation. So really it's in sharp contrast to where we were in April this year, where there was a lot of complacency around the deal being done. So I think the risk-reward is probably moving in favor of adding some risk to North Asia. Now, I don't think that you will be immediately rewarded for that, as you highlight that the next big event is in Osaka at the end of this month. There's a chance that leads to, the theatrics of the President of the United States, the President of China, coming out with an agreement. And remember that many of Trump's agreements are often, not really agreements, but just a sort of cooling of tension. I do think there is a lot of pressure on the White House from businesses that are really suffering from the uncertainty around the trade dispute, particularly the powerful technology businesses, which are sort of center stage when it comes to this dispute with Huawei, with the inclusion of the new tariffs. So I think the risk-reward is to add a little bit more risk because tensions around trade are high. But I would be doing that in a measured way. But my bias is add a bit of risk rather than get too caught up in the bearish sentiment.
Adrian, so you're essentially saying that this is now the studied assessment could be that this is more rhetoric rather than anything else. After all, the White House did climb down on the issue of Mexico. So many expect, well, a similar kind of thing can happen with other issues like the one with China here.
Yeah, I read a few articles which were talking about a multi-generational trade war, and those really appealed to the contrarian in me. When I think this is short-term politics rather than a multi-generational issue. It's very difficult for markets to judge because the way that the tweets from President Trump vary day to day is quite extraordinary. We've just lived through the experience of the Trump presidency threatening tariffs to deal with an immigration issue rather than an economic issue, and how that brought markets quite a bit lower. Then you get the relief rally. So I think that the dynamics here are going to be ongoing volatility, but to some extent you develop a bit of scar tissue to these frequent changes in news flow, and it perhaps moves on from being the absolute dominant issue. Other issues that are clearly very important here is macroeconomic data. We just have, another poor data point for Chinese auto sales. People are clearly going to be sensitive to U.S. economic data, and the labor market data was weaker than people expected out of the U.S. And remember the labor market has been a sign of significant strength within that economy. And perhaps one of the more optimistic ways of looking at this is that if the Trump administration wakes up to the economic risks to the U.S. economy of their policies, then that might be the most powerful way of getting them to roll back on some of this rhetoric.
About the economic impact of all this trade uncertainty and disputes is slowing growth, and that leads us to the next question about a possibility of a rate cut. The market is pretty much pricing in a Fed rate cut on the 18th and 19th of June. Are you in that camp? And what would be the total quantum of rate cuts we can see from the Fed, say, in 2019?
No, I think there's a risk to markets there You can see that markets are pricing it in with the unusual shape that we've got in the yield curve. I don't think the data at the moment would justify the Fed using this very powerful weapon to boost the economy. So I don't believe that there will be a rate cut at the next FOMC meeting. I am sure that Chairman Powell will come out with statements about his willingness to do it, but I don't think he will get it at the June meeting.
Fair enough. I mean, but we are due to get some more data out of the US this week, and maybe probably change what happens on the 18th and 19th. But as of now, you're saying that you're not expecting a cut. There is this talk, Adrian, that maybe the cuts which we could get are more of sort of insurance cuts, basically preempting a slowdown which may happen, an attempt at prolonging the expansionary phase we've seen in the US, rather than sort of responding to a real slowdown. Your thoughts on that? And if we do get those preemptive cuts, what would it mean? It would be a bit of a Goldilocks scenario that growth is not slowed down and yet rates are being dropped.
Well, remember that most loans, short-term money markets are already pricing in a cut. These are the reference rates are the market, not the Fed funds rate. And so the benefit of lower interest rates is already there. I think there's a risk in the Fed cutting in that it might actually hit confidence rather than helping confidence, in that it gives a sense that they know a little bit more about the economy, and that might be more negative than what's currently priced in. So this can work both ways.
Adrian, you spoke about adding risk in a measured way. Where would you be looking to add risk?
So the real damage to markets since the April highs have been in North Asia, and particularly around the tech space. Also, some domestic consumption plays in China. We've seen China announcing an increase in infrastructure spending. I think there'll be quite a lot of support for the Chinese economy, and that will then be reflected in better performance in their capital markets. If we can get a bit more clarity around the tech space, then that might help the markets in Korea and Taiwan. So I think I'd be selectively looking to add a little money back to China. With regards to India, India has been a very significant outperformer. You've had the most important positive surprise that we've seen in emerging markets this year, which is the large majority for the Modi government. And that was reflected in a strong outperformance in the market. I think India's entering a bit of a consolidation phase, but it will still probably be one of the preferred markets in that it's deemed to be a little bit more isolated from the trade tensions than the North Asian markets. But for now, I would be looking to take a little bit of risk off in India and just very selectively add it to China.
Fair enough. And are you expecting a bit of a pullback, because we are not very far from all-time highs? I mean, a pullback meaningful enough to provide sort of entry points, and what would you look at?
Yeah, so I actually think that if this level of trade tension persists, then markets are going to struggle to have much direction. And I think there's a risk that the Indian market, where investors are sitting on some quite nice year-to-date profits, that you see a correction. Now, the correction that we've seen from the Chinese equity market highs has been just over 10%. And I think a correction of that order is possible, particularly at a stock level.
Adrian, one final question. You said you will look to take a bit of risk out of India. In which pockets?
Well, it's clearly the stocks that have done the best out of the election or post-election rally. So some of the banks, cement stocks, some of the infra names, that's where I think investors will look to, reduce their positions. They'll probably still like these things on a medium-term view, but, just precautionary preserving a bit of capital makes some sense.
And the FIs pumped in a lot of money as soon as we got the election verdict and we had the NDA thumping back, enjoy a thumping victory. But now, of late, the FI signals in the cash market have been buy and sell. It's a mixed picture. What is your assessment of the FI investor sentiment towards India?
Yes. So remember, when you look at the FII assessment or the FII flow into India, think of it as two components. One component is, are people buying emerging market risk or not? So are we seeing flows into big EM passive products? And the answer at the moment is there is no convincing trend because of these, what we've already discussed about China. Then you have the reallocation in the actively managed funds. And the trend that we saw post the election was investors that had understandably reduced positions in India, unsure about the election outcome, then recommitted capitals. So I think the FII data is going to sustain the most recent trend, which is going to reflect more the global risk-on, risk-off dynamics that we've got around this news flow on trade, as opposed to the India-specific. I think the other thing that we need to talk about here, just beyond what was happening with the election, is the other big surprise is how much the oil price came off. There was a sense as we were finishing the third quarter of quite a lot of concern around the oil price moving higher because of issues in Libya, because of the removal of the sanction waivers. And that dynamic didn't plan out, and the oil price has corrected quite a bit. And we all know that India is the biggest beneficiary of that within EM.